This Week in the Boardroom, brought to you by NYSE Governance Services Corporate Board Member, along with Governance Knowledge Partners, the Center for Audit Quality, and Grant Thornton, and contributing partners, National Investor Relations Institute, and the Society of Corporate Secretaries and Governance Professionals.
Welcome to this edition of This Week in the Boardroom. I'm TK Kerstetter, the chairman of NYSE Governance Services Corporate Board Member, and it's my pleasure to welcome you to the show, which is going to be a very unique show. We have our annual Boardroom Summit being held here in New York. One of our guest speakers that's actually also joining us for the show, it's my pleasure to introduce Jack Bogle, who is the founder of the Vanguard funds, the world's largest mutual funds family. It happens to be, which I told Jack, the first fund that I ever bought in the 70s, the Vanguard 500 index fund, so I feel like I've been with you for a very long time, Jack. He's also the author of 10 books, all on investing and giving great advice. And Jack, it's just a pleasure. You're a legend in this business. In fact, I couldn't get you on here without the people all around wanting to get a piece of you. It's a pleasure to be on This Week in the Boardroom.
Good to be with you, TK, always.
In your book that you published in 2011 called Don't Count on It, What Went Wrong with Corporate America. And I'm going to read this because I'm really curious to get your view on this. You said, why should the board bear the ultimate responsibility when it doesn't have the ultimate responsibility? Of course, the director's responsibility is large indeed, but it is the shareholders themselves who bear the ultimate responsibility for corporate governance. Decipher that for me.
Well, it's pretty simple. I mean, if you're going to be, let me assume for the purpose of argument here, you're the sole owner of a company. You don't care who the CEO is, you don't care who the directors are, your will be done. And I don't see why that principle would change when you have 100,000 shareholders or 1 million shareholders. The stockholders own the company, they get the last word, and one of the problems we've had here in the US at least is that we've kind of lost sight of the idea that serving the shareholder comes first. Companies are pretty good, big corporations are pretty good in serving their own interests. CEO compensation, let's give a few bucks under political contributions now, those kind of things. And the CEO's word goes, but everybody needs, TK, I think, some oversight. There should be a final arbiter. And here, it's the owners of the company. It's as simple as that.
But isn't the board of directors, in theory, aren't they the ones that have been designated by the shareholders to represent their interest in that? Because you know the shareholders, we've got institutional investors, we've got pension fund managers, we've got me when I was first, we've got mom and pops. So aren't the directors supposed to be representing the interests of all those shareholders?
Of course they are supposed to be representing all the interests of all those shareholders. But I think we've gotten to a CEO-centric, if you forgive the expression, way of governing the company where the CEO, with all the information in his hands, he outguns the directors and what they can possibly know, and he's able to be, in many cases, almost a dictator. He's the face of the company, the voice of the company. He's not unlike a dictator because he can be, these are when things are going well, can not easily be challenged. And I've been one, TK, and I know. And now there are a lot of differences when you start a little company like Vanguard, tiny when we began, 39 years ago, almost to the day. And you got to get things done. You have to act like a dictator. You've got some novel ideas, some disruptive ideas, and you got to bull your way through all that with the directors. But ultimately, it is the shareholders whose money is at stake. They put up the capital, and if they don't like the board, theoretically at least, they can elect the board that they do like.
Well, we've certainly seen changes in the last 5 years. We don't see as many imperial CEOs, what I would call, that really control the roost. I'm not going to argue that they aren't still existing out there. And we've seen boards try and take more control of at least the recruitment process of directors and trying to do that. Let's switch that gear a little bit though. There's also the thought out there that board member or shareholders have received too much power, that with the changes that's happened, 452, which eliminated the discretionary voting of officers. We've got majority voting in almost all of the Fortune 500 companies. all of a sudden there is we have say on pay. We have the situation where people are sitting on the shoulders of the directors watching every decision. You wouldn't like that as CEO of having somebody do that. I don't like that. So I'm very curious on your opinion of where the power of the shareholder stands today versus where it did. Is that a positive or a negative?
Okay, well let me go back, if I may, a little bit in history, and that is the famous study done in the 30s by Burley and Means about the separation of ownership, a huge study at Columbia University, separation of ownership from management. In other words, we had a whole lot of small shareholders, and the managers of the company could do pretty much what they wanted. Today, those tables are entirely turned. This is a new factor in corporate governance. And today, back in those days, institutions owned probably 5 or 6% of all corporate shares. These are financial institutions, mutual funds, pension funds, trust companies, and the like, own 5% of the shares of all the corporations. Today, they own 70%. A few institutions control corporate America. And what's interesting about this is, in spite of the fact that, in a lot of ways I agree with your hypothesis, but they have the power, but they don't want to take the responsibility. So financial institutions are notable for standing back. I call it the silence of the funds in one of my books. Standing back from governance, which is one of their essential responsibilities. So we've got to get corporations focused on serving the interests of shareholders, even though we've got a very unusual case where you're not serving the shareholders directly. The corporation executives, CEOs and so on, are agents for the corporation, and the heads of the money management firms are agents for their beneficiaries, mutual fund shareholders and the like. So we've got a system that needs some work to get it straightened out so that we're certain that the corporations do what they must do, shareholders first.
I forgot to say this in the beginning. If somebody's tuning in the middle of this and they see you in a sling and me in a cast, they're going to wonder what kind of show they're watching here. But let's just say that we are doing ahead of our time, age-appropriate events that evidently has led to some kind of, but it hasn't hurt our show at all. But in case somebody's tuning in, I wanted to make sure that they know it wasn't a healthcare.
It's funny, it should show our determination to show up when we've been asked to do something.
Right, that it does. Well, the last thing I want to talk about is you have shown some frustrations in some of your writings relative to the boards of directors. Now, I'm not sure that I agree with sweeping statements that the boards as a whole, haven't been doing their jobs, but obviously you don't have to look far to cases where we've seen, cases where they haven't stepped up to the plate like they need to. But here we've got, 425 directors going to be sitting in the room. You or I are about to go up and address them. What would you say to these folks about, A, their performance in the past and what they should be doing sort of going forward?
We're at a stage here in this conversation where the only answer to that question is, it all depends. What kind of a company are you director of? Large or small, venture, old economy, new economy, a company that's got some momentum and is growing, a company that's seriously troubled by financial issues and is under the government's gun. All those sorts of situations are different. So basically what unites them is that responsibility for the board remains. Make sure you've got the right CEO, but make sure he's doing the right thing for the company. And honestly, the biggest problem we have in the large companies, which I think is where you see the most problem, is CEO pay is just totally out of control. Why is that? Because we've got consultants who advise the board, they put you in your little quartile, and the directors never like to see their wonderful CEO in the fourth quartile. Move them up to the first, and then somebody else falls into the fourth. So we have this ratchet effect that takes CEO compensation, I think, beyond all reasonable levels. But given the society we have, this ownership society, by institutional owners controlling it, the heads of these institutional companies are also run by guys that make an awful lot of money. So they're not about to protest. They probably think pretty good, because the higher their compensation goes, the higher mine will. And when you start doing peer comparisons, when you're talking about compensation, I think we should go back to doing performance calculations to determine pay, like return on capital over the return on capital for your industry, return on capital over the return on capital of all American industry, because maybe you're in a bad industry and ought to think about that. So there are ways to do it, but it goes back to focusing on not the stock price, which is one of the things that had us in this mess we have, focused on the momentary price of the stock rather than intrinsic corporate value. And the great Buffett will tell you, in talking about Berkshire Hathaway, that when the price of the stock goes above its intrinsic value, whatever that may be, he admits it's hard to calculate, it's great for sellers and bad for buyers. And when the price of the stock goes way below intrinsic value, it's great for buyers and bad for sellers. But they're just going back and forth with each other. So the stock market is a very deceptive, in fact, derivative of the value of corporate America.
Yeah. In the great runs of the stock market in the 90s, people were not improving their market position, they were not improving their peer position, but they were making a bloody fortune, okay, off of a market which they didn't improve their individual companies.
Well, what happened is stock returns come from value, dividend yields, and earnings growth. That's the fundamental, and in the long run, that's all there is to stock returns. But in the 80s and I guess the 80s and 90s, the price earnings multiple, valuation, if you will, of stocks goes from 10 to 20 to 40. And for that to recur in the first decade of the 21st century, it would have had to go to 80. So when people say the market is fine, they're basically saying, I don't see anything the matter with an 80 price earnings multiple. Well, except it's totally unsustainable is what the matter with it is. So we need to focus more on corporate value, intrinsic value, than on stock prices. And a lot of companies get that wrong. A lot of companies will say in their annual reports, our mission is to increase shareholder value over the long term. But if you measure shareholder value by stock price, you're deceiving yourself, because that's a function of the market's hope, greed, and fear, as always.
Jack, I just wanted to thank you for taking the time to join us here. And that will conclude this edition of This Week in the Boardroom. We hope you enjoyed the show. We'll be back again next week where we take another look at board committees and the board of directors to help you be a better board member. Thanks a lot, and we'll see you then.
Join us again next week for This Week in the Boardroom, brought to you by NYSE Governance Services, Corporate Board Member, along with Governance Knowledge Partners, the Center for Audit Quality, and Grant Thornton, and contributing partners, National Investor Relations Institute, and the Society of Corporate Secretaries and Governance Professionals.